obvious victim of a rampant dollar. And you could even see China get into trouble in terms of protectionism and a dollar squeeze. And that could really bring about trouble in emerging markets. Also, the Eurozone is threatened by Trump's election even more obviously than the EM countries, because you're seeing this take place with the elections in Italy. You're seeing disruption in other countries, whether it's Spain, the periphery countries. That, I think, is going to be one of the fallouts, that you're going to see further fallouts develop in Europe. And just imagine what happens if Europe starts to come apart, or as a result, the bond market rebels against Europe. So there are a lot of bigger picture implications of all of this.
Now let's talk about the implications in the stock market, because the Dow is at records, S&P at records, and NASDAQ at records. So the markets seem to like this.
There was a lot of money, you got to remember, prior to the election, because it was going back and forth. Hillary Clinton was moving in the polls, and at one time, Trump coming out of the Republican convention, he was moving up, and then we had the FBI, all those kind of things that was going back and forth. So there were a lot of people that were sitting on the sidelines holding off with their bets based on the outcome of the election. I think the markets have gotten ahead where they think this is going, because even if Trump was to get everything he wanted, as we have talked about in the past, it's going to take time to get these things ready. So I think the growth, the inflation, all the things that the market is reacting to now is a second half story for 2017, John, because you and I have followed politics long enough. We know it takes time before either monetary policies get impacted or you see stimulus spending take place. There was an article in Barron's this week about, they call it BAB, or Build America bonds, where Trump, rather than trying to escalate the deficit, because he knows he's inheriting $20 trillion of debt, he cannot do what Obama did in 2009 and increase the deficit by trillions of dollars each year. And we go back to 1.5, or I think the largest deficit under Obama was 1.4 trillion. He can't do that. The markets will not let him get away with that. So he's going to have to figure a more creative way to get around and finance these deficits. But it is going to bring a change in allocation. And I predict you're going to see money start to move gradually out of bond funds, and we're going to see the great rotation into stocks, where stocks are going to become the new bonds.
What we're not saying here is that there's an imminent crash or move out of the market. All we're saying, I'm assuming, is that there's going to be a different type of market.
Oh, absolutely. Because if you are going with a reflation trade and assuming that inflation begins to climb, interest rates begin to climb with sizable tax cuts, increased infrastructure and defense spending, protectionism, and a stronger stance on immigration, all of these, John, are inherently inflationary policies. So the real question is, what will happen at the Fed? Because if Trump lowers taxes, creates economic stimulus through fiscal spending, but the Fed gets aggressive and raises interest rates, they will basically nullify everything Trump's doing. And in this case, with $20 trillion of debt that he inherits, that would squash it. There's already talk on Trump's economic team. He's talking about appointing a new Fed regional governor and a new Fed chairman when Yellen's term ends, I think, in 2018. The Fed has got to tread lightly here. If all of a sudden they withheld raising interest rates for 7 years and only raised them twice in a 2-year period, and all of a sudden Trump gets elected and they get really aggressive and start raising interest rates, there's going to be a political backlash to that.
Like you say, anything that President Trump does when he's in office can be offset by something that the Fed does.
The real question is what's going to happen at the Fed. The Fed has already given us an indication that they will likely not rush to tighten monetary policy. The Fed is anticipating maybe only 2 rate hikes coming next year, which would put us at about 1.25. Remember, this year we start out with markets predicting 4 rate hikes. It looks like we're only going to get 1. There's a lot of things that are going on here, and you would see a backlash in the political field of all of a sudden for keeping interest rates as low as they have, and then to get very aggressive on raising interest rates as a result of the unemployment rate. And John, we know the unemployment rate, which fell to 4.6%, was mainly due to the participation rate. 500,000 workers dropped out of the job force. That's not a way to get lower unemployment. Theoretically, if enough people stop looking for employment, you could get the unemployment rate down to 1 or 2%. I mean, there's 94 million teenage that are out of work right now. The problem that is going to constrain some of this is the global environment remains marked by a deficient demand and is still in a disinflationary trend, even though what might happen here may go in the reverse direction.
If you talk about inflation, gold always does well, but actually, let me see, gold has fallen since Trump's election. It's usually a panic metal, let's put it that way. So what are we, in a reflationary type of environment?
Well, in a reflationary environment, you would see gold go up. That's exactly what it did in the last decade, where you had Greenspan raising interest rates in 2004. So you had rising interest rates and rising gold prices. Initially, the dollar fell after the election. Since the election, the dollar is up about 4.5%. So they are reversely correlated. Typically, in a reflationary environment, you see healthcare generally do well in inflationary periods. There's a number of reasons. Drivers behind that: an aging population, emerging markets are adopting healthcare safety nets, and pricing power is expanding in the healthcare sector. Consumer staples always do well because they have the ability with brands to raise prices. Consumer discretionary would do well. Real estate would do well. Energy is doing well, one of the best performers next to gold this year. Financials typically would do well with a steepening yield curve because the banks pay you less on your deposit, but they're going to charge you more on loans. And then the other thing that's going to be doing well is capital equipment, industrials, and materials. So there is going to be a major paradigm shift here in the markets, assuming that these policies are enacted within the first 100 days. Because, John, we know that anytime anything gets done in Congress, you have two political parties, you have special interest groups, and they're not going to just lay down and say, okay, you guys can have your way. They're going to try to influence the process. It's like a sausage-making process, and it's going to take time. But the one thing that Trump has going for him, he's got both houses of Congress. The Republicans have been sitting on a tax plan for almost 8 years under Obama. So they've got that ready to go. There will probably be some ironing out of differences. Trump can get the Democrats to go along on infrastructure spending. There's probably going to be some negotiating on spending in terms of defense. But these things are going to be enacted probably in the first half. There's been a lot of stories out in the government media that Trump is inheriting the strongest economy of any president. In other words, President Barack Obama is handing off to Trump the strong American economy, and we disagree with that assumption. But, John, this is a major paradigm change. And just as you shifted your portfolios coming out of the financial crisis in 2008 and 2009, it was amazing because everybody throughout that period were expecting to see another major crash when the crash already happened. The stock market went up over 2%. Interest rates fell down to the lowest levels in history. There were paradigm shifts in the market. Those paradigm shifts are coming once again, not just here in the United States. They're coming globally.
All right, Jim, we have to wrap it out here at the bottom of the hour. Your website is financialsense.com. You do a weekend 2-hour program that I co-host with you, or at least participate in. And you also have a daily show during the week, as well as a special series on Mondays and Tuesdays called Lifetime Income, Planning for Retirement. That's at financialsense.com. Out of time for today. Happy New Year for everybody else. Hopefully next week we'll be back on our normal track. If anything